Every day in the stock markets there are likely thousands of people buying stocks for the first time, based on a hot tip from a friend or colleague. Very often the stock purchase doesn't pan out, they lose money and are left with a bad experience from investing in stocks. There are two important things to note about this guide. The first, no hot stock tips are offered, and the reason for this is straightforward. Investing based on tips simply does not work for a serious long-term investor. Long-term here assumes a period of 5 years or longer. Many people want to learn how to invest successfully, but they are intimidated about the stock market. Some feel investing is just for really smart people and don't want to lose money. The objective of this guide is not to make you an expert but to provide simple and smart investing information. After watching this video and following the steps discussed, you should have gained significant confidence to find and buy your first stocks. The second piece of good news is that this guide video can be watched and understood by the average person within a few minutes. It follows a step-by-step approach and is intended to help a novice investor develop a simple understanding of how to find publicly listed companies that are great to invest in for the long term, how to make an uncomplicated decision on whether or not to invest in a company's stock, what to consider in deciding the timing of your purchase of stocks, what percentage of your available funds to invest based on your personal circumstances. The focus of the discussion is on buying individual stocks only. However, some of the principles can be applied to other instruments like index funds, exchange-traded funds, or mutual funds. No other investment or trading strategies, such as short selling or options trading, are explained in this video. Number 1. Finding potential companies. A public company having shares freely traded on a stock exchange that consistently generates significant revenue and profit, and regularly receives your hard-earned money should be considered a potential investment candidate. Better still, if you spend a lot of time using its products or services without directly contributing towards the company's profits, consider it an even better candidate. That's because you get the benefit of using a good product without having to pay for it. And the people paying the company could be paying you indirectly as a shareholder of the company. Identifying potential companies is easier than many people realize. Think of the things you do, have to use and spend money on regularly. Start by making a list of the companies that provide those products or services. A few examples are social media companies, communication service providers, streaming services, utilities, financial services and grocery stores, clothing and footwear retailers, entertainment companies, gas stations. Feel free to add as many suitable companies as you can think of to this list, since this is just the first stage. Once you have compiled the list, you are ready to move on to the next step: fundamental questions. Number 2. Fundamental questions for good investments. Having identified your potential candidates, now ask yourself the following critical questions about each of the companies. Some basic research may be required to objectively answer them. However, you should not need to spend more than 30 to 45 minutes on each company. 1. Do its products and/or services provide a key service to consumers? 2. Do the products and/or services have a wide consumer demand with opportunities for demand to increase? 3. Can it develop new products or services that will generate increased profits? 4. Does the company have a competitive advantage over its rivals to protect its market share and profits? 5. Does it have excellent senior management? Take a few minutes to learn about the quality of its chief executive officer, chief operating officer, and heads of the key divisions. An exceptional CEO will usually hire and be supported by a talented management team. Lastly, if the answers to all the questions above are yes, find out if the company has had any significant negative events in the last 3 years which could impact its future growth. At this point, your initial list of companies should have been significantly reduced to a few very high-quality names. The final list will likely include growth companies, value companies, or companies that are a mix of both. According to Investopedia, growth stocks are those that have the potential to outperform the overall markets or a sector of the markets over time because of their future potential. Value stocks are considered to be currently trading below what they are really worth and will therefore provide a superior return. The type of company you chose to invest in will depend on your investment time frame and your risk appetite. Your next thought should now be when and how best to start investing in one or more of the companies you screened. Number 3. Simple technical analysis. A simple definition of technical analysis from Wikipedia is an analysis for forecasting the direction of prices through the study of past market data, primarily price and volume. There are dozens of technical indicators used by professional traders and short-term investors, and some new investors might be intimidated by these. Fortunately, many long-term investors do not rely too much on technical indicators when making investment decisions. Some technical analysis is helpful in determining when to buy or sell stocks, and that is the focus of the discussion in this section. An analysis of price and volume action, the two most important components of stock investing, is sufficient to get you started. Find the stock chart for each of the companies selected and look at the share price and volume of shares traded each day over various periods of time. For example, if you want to do this for Microsoft, simply do a web search for Microsoft stock chart. A few stock charts will come up, so choose the one you feel is most user-friendly and look at the price and volume action of Microsoft stock over various time periods. Price. Look at the current price of the stock and compare it to where it has been in the last 52-week, 5 years, and 10 years. This will help you determine where the stock price is currently, compared to where it has been in the past. Generally, you want to buy at a low price and sell at a much higher price. However, you don't know where the stock price will be in a few months, so the price analysis is only one piece of your assessment. Volume. Look at the daily average trading volume over a period of time for large and well-established U.S. companies. For example, look for daily average trading volumes of 500,000 shares and greater. Stocks that regularly trade more than 1 million shares daily likely have institutional ownership, which is usually a good sign. Price and volume action can generally help you determine if there is a trend in the movement of the stock. High trading volumes over a period of time, when the share price is also moving higher, is very positive and reflects investor demand for the stock. Conversely, high trading volumes over a period of time when the share price is moving lower is usually a negative sign. In addition to examining trends for a stock, also look at the trends for the sector in which the stock belongs. Using the earlier example, Microsoft belongs in the technology sector. So you should examine the chart for the technology sector in a similar manner as you did for the stock. Ideally, you would want to see a strong correlation between the stock and its sector. This means the movement in both the stock and its sector should generally be in the same direction. There are positive and negative exceptions to this. A stock with upward price movements when the sector is moving down is generally very positive. The reverse is usually a negative signal for the stock. Number 4. How to buy. Having decided what stock you want to buy and at what price, you need to determine how much of your investable funds you want to allocate to that particular stock. This will depend on a few factors, including how many stocks you want to own in your investment portfolio and your risk tolerance. A safe strategy is to have not more than 5% of the value of your portfolio in a single stock. In the event things go wrong within the company and the stock price plunges with no chance of recovery, your maximum loss will be limited to 5% of your portfolio. When buying, it is advisable not to buy the full quantity of a particular stock all at once. A good practice used by many experts is a strategy referred to as dollar cost averaging. This involves the gradual accumulation of a stock position over a period of time and at various prices. This can protect your investment from market and share price fluctuations, which often occurs after an initial purchase. One of the advantages of this approach is that after each purchase of the stock, you can assess what the stock/company, its market sector, and the economy are doing. Dollar cost averaging is not a recommended strategy for traders and short-term investors. Using the example above, if you were planning to buy 100 shares of Microsoft, you could buy 20 shares monthly, quarterly, or every 6 months, depending on your investment time frame. If the share price falls in between each purchase and there are no significant concerns with the company, you would be adding to your previous position at a lower price. This allows you to average out the total cost of your 100 shares and buy the shares at a lower average cost than you would have, compared to if purchased your full position at once. On the flip side, if the price moves up after the initial 20 shares are purchased, subsequent purchases would be at higher prices, resulting in a higher average cost. In this scenario, if the uptrend holds and the economic conditions remain strong for a considerable period, this would also be profitable, although riskier. Another way to dollar cost average is to invest a fixed dollar amount periodically, as in this previous example, for instance, $1,000 monthly, rather than buying a specific number of shares periodically. If the share price falls after each purchase, your $1,000 would buy more shares at the lower price, resulting in more shares owned. Number 5. When to sell. When to sell a stock is entirely up to you. Your objective when you bought a stock was to be able to sell it at a much higher price than when you bought, thereby making a capital gain, or to earn income, or both. Some long-term investors hold certain stocks for decades and even transfer investments to family members, while others might sell stocks 6 months after buying. Whenever you buy a stock, you should have a general idea of how long you want to own it for, or how much profit you expect to make from the stock. Review your investments periodically depending on your investment time horizon, or whenever a company's circumstances change, reassess your holdings and determine if you need to make any changes, such as adding to, reducing, or closing any of your positions. For example, if you own a high-growth stock and your objective was to make a 100% gain on the stock in 6 months and the stock price doubled sooner than you expected, you might want to sell half of your position. By doing so, you are essentially taking out the full capital gain and retaining the balance, which is now the value of your original investment. Note, fees and taxes are not considered in the above example, as these items depend on where you live and the type of investment account you have. Learning how to invest does not have to be complicated. There are different ways and levels of investing. You can start at your own pace and find what works for you, based on the type of investor you want to be and your personal circumstances. Wishing you much success on your investing journey.